joining us for a webinar that is another collaboration between Property Tribes and our friends and partners at Lendlord. Aviram from Lendlord is joining us, and a bit later on into the webinar we're going to be using the Lendlord software to show how landlords can manage their portfolios more effectively in an inflationary environment. We are drilling down on a trending topic that landlords have been discussing in great depth on Property Tribes. We've got a thread ongoing which is called Thank You Mr. Inflation, I'll Ride Your Wave, and at the time of recording we've had over 70 responses. Very interesting topic. We need an expert, and luckily on Twitter I came across Andrew Sissons, who works at Nesta. And Andrew, welcome along to the webinar. Tell us just very briefly about your work at Nesta.
Hi Vanessa, great to be here. So I work in a team at Nesta called A Sustainable Future, which is all about trying to tackle climate change and get the UK towards net zero. And we do actually focus a lot on homes and the home sector, but I also have a background as an economist in various different bits of economics, and hence I've written widely around various topics. And obviously inflation is one of the big topics in economics, and is hot at the moment.
It sure is, and I really liked your blog, Andrew, because people tend to look on inflation in very negative terms, but actually there's some quite positive things that come out of it, and that's what we hope we can kind of discover and talk about today. So just in a nutshell, 101, what is inflation, Andrew?
Sure, so inflation is things getting more expensive. It's the gradual increase in price over time of goods and services. The way it's calculated is effectively that the ONS, the government's kind of statistics body, takes like a basket the typical consumer, like you and I, consumes, including things like your food, your rent, the money you spend on recreation, etc. And they just track the price of all of those goods and services, and then they aggregate the whole thing and compare it to the price of the basket this year compared to last year. And that sort of one minus the other is the rate of inflation. And so normally, you know, inflation, you don't really notice it. It's around 2%, something like that. But occasionally you get certain spikes for whatever reason, and which is what's happening at the moment. And that causes inflation to rise much more quickly, which means you see the price of things go up. And there's a lot of other issues that come alongside inflation, but it's fundamentally about prices going up. And one of the knock-ons, of course, is that changes the value of your currency. So because prices are set in pounds, if you have to spend more pounds to get a certain product or service, effectively the currency is worth less. And so you get this sort of effect where stuff gets more expensive, and so the pound in your pocket, as per the famous quote from decades ago, is worth less. And so you get, but there's a whole set of interactions that come with that. We're
kind of in interesting times in terms of the inflationary environment, because we've had what I would call internal inflation, which could be Brexit, COVID, etc. And then we've got now external inflation, which is the Ukraine-Russian war. Let's talk specifically about property. What would you say are the negative aspects of inflation for property investors and landlords?
There's a couple of issues, I guess. One is that typically the response to inflation going up is for interest rates to rise. And of course, that means if you have debt, if you have a mortgage, you're likely to see interest rates rise. Whether that is how much they might rise and whether that will be sustained is a really interesting question right now. And I think, you know, typically if you go back to the 1970s or the sort of early 1990s, when inflation shot up, interest rates went up. I think it was to 15% in the early 1990s. But what's going on, I think, now is a slightly different situation where a lot of the inflation is potentially a sort of one-time effect caused by the end of COVID and by the war, and it's something that may well tip back into it, sort of come off the peak quite quickly. And actually the Bank of England, which is of course the body responsible for setting interest rates, said last week that this bout of inflation may well actually tip us into another recession. And that normally brings down inflation. Sort of contracting the economy will normally bring down inflation, and that means that if you're the Bank of England, they have obviously raised interest rates a little bit, but actually you'd be very nervous about raising them too rapidly, because it looks as if the economy may well tank again. So if you were to sort of jack up interest rates very rapidly, especially with the level of mortgage borrowing there is in the UK, you'd be very nervous about there being a crash. So I think the big downside is that risk of interest rates rising, but I don't think it's quite as straightforward as you'd normally think. You'd see inflation at that level and you'd think interest rates are going to go through the roof. I'm not sure that is quite true today.
Okay. That's interesting. Obviously, there's the issue of tenant affordability, because their affordability is stretched, could result in them being unable to afford the rent. Obviously, we've got the energy crisis as well, which is all part and parcel of this kind of economic mix. So there are things that landlords need to be mindful of in this kind of inflationary environment, I would definitely say. You mentioned the Bank of England has obviously used the base rate as one of their main tools to bring inflation down. How effective do you think this is? And would you say there could actually be what's called a healthy rate of inflation that actually sustains the economy and drives it?
Ultimately, the Bank of England interest rate is very effective at bringing inflation down, but the problem is that it does so effectively by making everybody poorer. So if you want to control inflation, the classic way is you put up interest rates, you hit people in the pocket with higher charges, and that shrinks the economy, which brings everything back down. It stops the kind of runaway increases in prices. So it's a very effective tool. Problem is, for the reasons I sort of outlined, the Bank of England's like to be very nervous about using it extensively. I think, though, in terms of that question about whether there's a kind of healthy rate of inflation, the emphasis, since the Bank of England became independent, it's had an inflation target of 2%, and it's hit that sort of on average. I think 2.1% is the kind of average annual inflation for the last 25 years. But one of the things that's happened since 2008, since the big financial crash, is that the economy has been very weak, and ultimately the Bank of England's had to have very low interest rates just to keep the economy ticking along at a kind of very low level, that quite low level of inflation. And that's sort of purely a function of the economy being weak, of there not being any sense of kind of growth or movement in the economy. And one of the things that, suddenly having this bout of inflation, there is perhaps an opportunity. We've often talked about normalizing interest rates, getting them back towards kind of 2-3%, a level which is much closer to the kind of long-term, actually low by historical standards. But in order to do that, you almost need to move the economy onto a slightly faster trajectory. And it wouldn't have been possible for years because the economy is so weak. If you were to raise interest rates, you'd just send it back into recession. With the bout of inflation that we're having, if you can find a way to sort of harness some of that and sort of get a bit of movement so that people having to move their money around, actually some debts are being eroded, because that's one thing inflation does, is it erodes the value of debt. What you might see if the Bank of England is very skillful is that they can shift things where inflation's a little bit high for a period of time, but actually it gradually raises interest rates and just sort of glides everything back to a nice path, which is a little bit healthier, a little bit with higher interest rates and perhaps slightly higher inflation than we've had for the last 14 years.
Okay, well, that's very interesting. You mentioned there one of the positive things about inflation, and that is it does erode debt. And my simple explanation of that, and please do correct me if I'm wrong, is that if you're in property long term and you have debt, then when you come to pay off that debt in 20 years' time, the money that you use to pay off that debt is worth a lot less than the money that you took out the debt with, if that makes sense. So I think that's right. Is that right, Andrew?
That's right. As long as the key thing is whether your debt is sort of nominal, denominated just in cash terms, or whether it's inflation linked. So if you have an inflation linked debt that goes up by, say, the rate of RPI or CPI inflation, then that gets baked in and your debt just grows with inflation. But most people borrow money, spend money, write contracts just in nominal cash. And if you had £1 million in 1990, that £1 million is worth a lot less today, and the same if you had a debt for £1 million then. It goes down, and the faster inflation rises, the more that rises. It's that point I made at the start, that when when the price of things goes up, the value of the currency goes down. So £1 million has become worth less over time. So you're absolutely right. For most people, as long as you borrow in that sort of nominal cash terms, inflation erodes your debt. And it's a classic, one of the classic complaints about inflation is that it effectively takes money from savers. So if you're a saver, unless you've been smart and invested in sort of inflation-linked assets, you lose money. And of course, what all savers do in the economy really is lend money to borrowers. So inflation, yeah, but helps borrowers, reduces their debt, harms savers, and that's the kind of classic complaint about it. So it may well be, the inflation may, depending on how your pension is managed, may well be taking money from your pension, but it's certainly good for those who've borrowed money in cash terms.
Okay, well, that's interesting. Do you think the other advantages could be around house price inflation, that the housing market has actually been extremely resilient over these very challenging last few years? House prices do continue to go up. We're seeing the price of materials going up, so that could affect the cost of new build properties and push them higher. I mean, I don't know how sustainable all of this is, because all the metrics do seem to be on up, and that kind of feels rather unhealthy to me, and it's got to come to an end somewhere. So I guess we're just relying on the Bank of England to be very prudent about how they use the base rate to try and control this. I don't know what other mechanisms they have, but it seems like a very, very fine balance to try and keep this under control.
Yeah, I think that's right, and I think yes, I mean house prices have been hot for a long time. There was a brief boom before 2008. There was a big crash, and there's been an even bigger boom that we're still riding. I think the thing you always worry about with house prices is affordability. It's whether people can afford the homes, and that's really a function of two things: one, wages, how much people earn, and secondly, the interest rate, how much they can afford to borrow. And what's happened in the last 10 years or more is that people's wages haven't gone up very much, but borrowing has been so cheap that it's meant that more people can enter the housing market, of course, do well from properties, and then can afford to borrow more and buy even more expensive homes, which has kept driving the price of homes up. The worry is if you get, so if this bout of inflation doesn't lead to an increase in wages, which may happen, it's a bit early to tell, but that's possible. That as you said, you have the point about whether tenants can afford their rent. It's the same for homeowners affording mortgage debt. On the flip side, so if you see wages sort of stagnate and you see interest rates rise, then yeah, you see a reduction in the amount people can afford. That could start to bear down on house prices, and that's why that kind of what the Bank of England does with the base rate it is so crucial. Because I think if you see some gradual rises and you get that nice kind of glide down to a better trajectory, the chances are house prices may not keep growing as fast, but they will certainly moderate. If the base rate goes up too fast, or if there's some other shock, there is a real risk of prices crashing, and the effects of that could be really complicated, because that then knocks onto other people's wages. That you potentially, to be honest, if there's a house price crash now, the economy will probably go into a reasonably significant recession, and that obviously then I mean we could end up in a year's time be talking about deflation, so actually prices going down if things go really badly. That would be the bad outlook. So it's a delicate moment. It's certainly, the burst of inflation could be a good thing, but if it sort of goes over the edge and it's handled badly, it could be a bad thing for everybody. And to be honest, recessions are generally bad, unless you're some kind of sort of currency trader who hedges, the pound or something. Recessions are bad for everybody to a large extent, and that's obviously something we all want to avoid.
Just interesting, Andrew, because normally I would say when house prices are going into some form of correction, then the kind of silver lining to that dark cloud is that then rents start to go up. But actually right now we've got house prices and rents both going up at the same time. I believe this is quite an unusual circumstance, and again, this does worry me about sustainability.
The things you worry about with rent is purely the ratio of wages to rent. It's whether people can afford to pay. And of course, in the UK, we do seem to have a shortage of housing, which will drive up rents and drive up house prices as well. If demand outstrips supply, that is something that happens. But you can get very complicated about it, but it's a fundamental thing. The market can only be sustained if enough people can afford to buy and want to buy homes as want to sell. And if you see either cost of borrowing go up or wages drop, it's as simple as very hard to sustain those things if one or more of those things drops. So that's the stuff I'd be watching closely and keeping an eye on. And is there a point at which house prices and rents can go up no further? There almost certainly is, but it's one of those things that it doesn't sort of happen in this nice logical progression. It's one of these days, a bit like the Dutch tulip craze or other kind of bubbles that burst. They tend to keep going and going and going, and then suddenly drop, as we well know. And that's the difficulty. So there is a worry about sustainability, but I don't think it's a given. I think what I'd say is that the Bank of England and the UK governments have paid a lot of attention to house prices and making sure there isn't a huge crash. And so I think you'd hope that there is a way of managing that issue in a sort of gentle, cushioned way, rather than just allowing a huge crash to happen. That's what I would expect to happen. But you never, in these times of turbulence, there's a lot of scope for the people in charge to miscalculate.
Well, indeed. But you touched on this very briefly earlier. Is it generally good to hold assets in an inflationary period?
It depends. It depends what the assets are. I guess. I mean, it's a question, but I think ultimately, what happens in an inflationary period is that the value of cash drops. So the worst thing you can do is have cash, especially if you're not getting any interest on it. Assets that hold their value, which could include homes, but it could include other, it could include stocks like, particularly well-performing companies that are resilient to shocks. Generally, they will keep their value, and it's that point. What inflation is a sudden loss in the value of cash, is one way of looking at it. And so in that environment, nobody wants to hold cash. Having assets is good, but obviously certain assets are more sort of will hold their value much better than others. And so and that goes back to the house price point is, yes, if house prices keep steady and inflation goes high, that's brilliant for people holding housing assets. If you get a house price crash, of course, that's bad for that. But of course, there are quite a few million people who own homes, so it's not it won't just be landlords. It's a quite widespread problem if you do see loss of house prices, and that's why I think there'll be such pressure on the authorities to try and avoid a sudden crash.
It just seems such a fine balancing act because in an inflationary environment, savings aren't worth anything. They're even going down in some cases. So that encourages some people to invest in property, and then that keeps the house price, the rises going up. It seems just such a complex thing with all these little levers that the authorities, as you say, they've got to call it right to control this. One of the things that was suggested on this thread about riding the inflation wave on Property Tribes was one landlord suggested that now was a good time to deleverage, and that would reduce your risk. Is that a good bit of advice, would you say?
Depends. What I'd say is that it depends on what you're doing with the money. Ultimately, there's sort of two things to consider. One is the point we talked about, inflation eroding debt. The other is the point about interest rates potentially going up. And would I be taking out a very stretching mortgage at a variable interest rate right now? I'd be nervous about it personally, because I think interest rate will rise somewhat. But I think the key question is what you're going to do with that money. If you're deleveraging, the money's going to be going somewhere. And I think it's a good time to be seeking assets that are good bets, that are going to be valuable. Now, it's hard to say what those are going to be. I would never suggest kind of putting money into things like gold, because gold is something that effectively gold gets more valuable when the economy is bad, because it's seen as a sort of safety. But what I think you're looking to do is to tie your money up in things that will have a return in cash terms, that even if cash drops in value, you still get the return. And that may be stocks and shares, particularly of more resilient companies. But I think whenever you talk about leveraging or deleveraging, it's always a choice about what else you're going to do with your money. And the key thing at this point is to not get caught in cash or in things which are likely to go down quickly. So I certainly wouldn't, deleverage only to keep your money in the bank. That would be that would feel like it could be a mistake.
I think it's interesting, Andrew, to look at this from both the seasoned landlord's point of view, somebody that's been in the game a long time like myself, and a newcomer landlord point of view, because I think that because I've had the benefit of being in the game a long time, I've had my debt eroded by inflation over a long period and so on, and I'm lower loan to value. I think I'm probably well equipped to withstand this. I'm looking at taking some longer term fixed rates, which we're going to discuss with Aviram shortly. But for a newcomer landlord, I think it's different for them coming into this inflationary environment. Would you agree?
Yeah, I think it is, and I think the big problem is it's very uncertain. The key thing here is the problem here isn't just inflation; it's potential recession, it's potentially interest rates going up. There's a lot of volatility, and I think there's a lot of things you might think are the logical response to certain events that won't be. It's very hard to predict. As I say, I could not predict and tell you what inflation or interest rates will be next year. It's a very difficult game to play, and so I think that it's a time to be cautious. If you're somebody who doesn't know the market particularly well, and even if you do, it's a time to not assume that the obvious things are going to happen, because there's a lot of volatility. And I don't think anybody can predict with any great certainty how things will move in the coming year or beyond. So clearly, yeah, as you say, for a new entrant to the market, it's a time to be cautious. I would have said.
That was my last question, actually. I was going to put you on the spot as to whether you could suggest what the rate of inflation might be this time next year. But even you don't want to give a suggestion to that.
I certainly can't give anything approaching investment advice or forecasting. But my guess is that inflation will be an awful lot lower this time next year, because ultimately what inflation at the moment is doing is taking money out of a lot of people's pockets. I think, in line with, I think the Bank of England's inflation report is the best sort of, the state of the art in terms of forecasting. And, my understanding is you're looking at inflation coming down. As you know, my hope is that it won't come down to zero. It will be a little bit higher than perhaps the 2% that's normal, but I'm not that hopeful. I think it will come down reasonably rapidly, in line with what the bank says. And of course, the Bank of England is forecasting a recession of sorts next year, which goes with that. So yeah, certainly not nothing approaching a forecast, but that would be my best guess.
Okay, well, interesting times ahead indeed. Andrew's blog was called, I think it was Letting the Inflation Genie Out of the Bottle. I'll put a link to that below this video for everybody that would like to explore it. And Andrew does a lot of work around heat pumps as well. So Andrew, I think we might have to ask you back for another webinar on that topic, because that's kind of a trending topic on Property Tribes as well. But thank you ever so much for those insights. I'd love to invite you to just stick around, because Aviram's been waiting patiently in the background there. Aviram is the CEO of Lendlord, which is a financial management platform and portfolio management platform for landlords. And Aviram, I've been going to Lendlord every couple of weeks over the last few months since we've had the interest rate rises, because I've got a few mortgages on standard variable rates. And every time I get the letter from the lender saying your monthly payment's gone up, I've gone into Lendlord and put the new monthly payment into my software. And I think this is so important, isn't it? Because for landlords in an inflationary environment, they do actually more than ever need to know that what their actual cash flow is, their net and gross cash flow. Because if you've got lots of properties and they're all going up by, say, £30 to £40 a month, it can add up to quite a significant increase, and landlords just need to be aware, don't they?
Yeah, absolutely. I think this is it's so important to basically to have your data at your fingertips. You need to be in control of what is the current situation. And also with Lendlord, you can also put some predictions. So I think that especially now when inflation rises, it's good to see, okay, where it can take my cash flow in 5 years or even in 10 years, and to see, like, to run some different scenarios and then basically make decisions based on that. And regarding the SVR rates, absolutely. I think that you need to know first where are your exit points in terms of the mortgages, and if you're on SVR, what is the current cost of your mortgages. If there are any other opportunities right now, perhaps it's better to fix the rate now for a longer term. And of course, all of this is available. If you use Lendlord, you can actually run some different scenarios and understand what is the best approach.
Well, indeed, because one of the solutions to kind of managing your portfolio in an inflationary environment is to look at fixed rates. That's what I've actually been doing this week, as it happens. I'm kind of thinking even 7 years. I don't know what you think of that, Andrew. If you were fixing a buy-to-let mortgage now, I think 2 years is too short. My feeling is 5 to 7 years, or would you think that maybe 5, because you're not convinced that the rates are going to go up too much more?
It's a very, very hard moment to predict that. Part of me says interest rates are low for a good reason, have been low for a good reason, and they'll stay that way. Part of me says this could be the moment that will changes. So it's very hard to predict, but yeah, in this kind of time of volatility, generally having certainty for longer is it feels like a very attractive option.
Yes, and there's still some actually very attractive rates out there, aren't there, Aviram? Some lenders have even reduced product rates in the last couple of weeks, which I kind of find quite strange. But I guess that it's because they want more business. Maybe landlords have pulled back a little bit in the last few weeks. But with Lendlord using the finance hub, landlords can actually see what opportunities are out there to fix their rates. If they're very risk averse, there are some 7-year fixes. If they're slightly less risk averse, there's some 5-year fixes, and they can weigh up all the options and just see which is the best for them and their portfolio, can't they?
Yes, absolutely. And I can show a demo if you would like.
Yeah.
Show exactly how you can do it. So if you, 1 second, let me share the screen. We start with my portfolio. So my portfolio is basically the place to store all of your property information. And of course, also the mortgage data. And I will switch in the views to the mortgage view. And here, basically, I can get all the details that I need about my mortgages. So I can see the current rate, and I can see also the type. So in this is the demo account, everything is fixed.
Oh, well, there's somebody that's not too worried.
Yes.
Well, I think most landlords have a mix of fixed rates and variable rates. I've always kind of rolled like that, really. But if they're on the lender's SVR, they will see their monthly payment going up, and it could continue to go up if the Bank of England continues to raise the interest rate there. So that's such a useful thing, Aviram, because of course, if you're thinking of remortgaging, you could still be in an early repayment period, and that would probably make it not very worthwhile to remortgage. So having all this information at your fingertips, and as I mentioned, updating it every time you get a letter from your lender saying your interest rate has gone up, your monthly payment has gone up, it's keeping a full understanding of where you're at with your cash flow. It's just, I can't stress the importance of this.
Yeah, absolutely. Another important thing, as you mentioned, are like the early redemption fees and the expiry dates. So basically, you can see that usually after the rate expiry date is over, the rate can jump to the revert rate. It's usually much higher. It's usually the SVR rate. So you need to be on top of also the expiry rates to do the product transfer or rate switch, or to remortgage at this point. on Lendlord, another important page is the mortgage search. So in the mortgage search, first you can search for a specific case that can be a new mortgage, a new purchase, and then you can see these are basically, usually we retrieve live results from the lenders. I'm saying usually because this might be something that was not up to date. So just click again on the search and then you will receive the newest rates from almost all of the buy-to-let lenders currently have products available. And you can also play with the fixed rate period. So let's say that in this case, I will take it to 5 years. Then I believe the rates will be a bit different. But of course, you can secure the rate for a longer time. So it's also important. Yeah, so it's like the rates are now a bit higher. And another important thing, when you look at a mortgage product, don't look only on the rate, there are also the fees. So if it's a longer period, then basically you can take the initial fees for like we take it for the entire 5 years. So if it's like for 2 years, perhaps it's different because then it's a shorter period that you need basically to take into account the fees. But you can also order by and basically see the results on different, based on the sort by different parameters. And another important thing, and we discussed about inflation. So on Lendlord, you can use the deal analyzer for two things. One, when you analyze a new property deal, and and I will show in a sec, you can also evaluate your existing properties. So let's take a potential deal. We just put some numbers here. So you'll receive the first year metrics and the long-term metrics. And then in this section, the long-term assumption, then you can define four things basically: the occupancy rate, property appreciation over the years. We take it from the postcode automatically, but you can change this based on your thoughts or data, rental appreciation, and annual inflation. So let's take a look on this deal. So in this, let's take it even to 2% here, okay? So in this scenario, this is my return after 10 years. If I now increase the inflation rate, then you can see that the total return going down, and also the internal rate of return is going down. So what happened here? Basically, what we do in our engine is the expenses side of managing a property will increase because of the inflation, and the rent currently is rising by 1%. But let's say if the rent will also go down, then the return will go down. If the rent, as you mentioned now, also the rents are going up, so perhaps you can balance the inflation. So the relationship between the annual inflation, the annual rental appreciation, basically will impact your long-term return when you hold a property for 10 years, 20 years, and you can go to the prospect report to see also it on a chart. So you can see in this chart, basically the development of your cash flow over the years based on your assumptions. And you can do the same, by the way, if you go to my portfolio and click deal analyzer, you can then evaluate an existing property for the next 10 years as well, with playing with the inflation rate. So
wow, that's just absolutely amazing. It's just such a useful tool for landlords to have in their back pocket to help them through. Well, it's like almost like helping them navigate through these challenging times, which I do believe are ahead. What do you think of that, Andrew? Do you think that's a useful tool?
Yeah, absolutely. I think at a time like this, knowing what you're having at your fingertips, the sort of assets and borrowing you've done makes an awful lot of sense.
I think one final thing, Aviram, you could potentially also use the Lendlord Finance Hub to look to see if you release equity. You might just want to do a like-for-like remortgage and not release equity. But if there's a lot of equity there, it could be worth considering releasing it. you know, well, maybe for a rainy day fund, but then obviously there's Andrew's point about where do you keep it. And the second thing is, you know, maybe that, you know, you might want to see if there is some kind of house price correction, and you know, maybe buy some more. But I think, you know, using the financial profiling software of Lendlord, you can really actually understand what your options are.
Yes, absolutely. I would use the view that we call it the equity view. It's only 3 fields: address, how much equity you have in each address, and the loan to value of this property. And then I will just order by the loan to value. And then I can see which properties are based on the last assumption of the property value, what is the current loan to value and the equity. Then I will click on the 3 dots and click remortgage. Once you do that, it will take you instantly to the mortgage search with all the details of this property that you stored on my portfolio. You just need to add a few more details about the mortgage. Let's say I want to take it to 25 years. It's a property owned by a company, so immediately we'll get it as a company property. A company, sorry, a mortgage. It will start the search, and then you can see the options for remortgaging this property. And if you want to do a capital raise, then you just need to mention how much you want to raise more. Click search, and we receive the revised results. So yeah, it's also it will allow you to understand what are your options in terms of remortgage with capital raising.
Well, as we can see, rates are actually still pretty favorable at the moment. So now is the time to take some action if you've got any mortgages on SVRs. Any closing thoughts, Andrew, on this topic for landlords?
I guess just to say good luck. It is, as you said, Vanessa, a really challenging time. It could go a lot of different ways, but I think it is being aware of what's changing, what's available, and how the market's shifting is obviously hugely important. And but yeah, of course, remember that there's a lot of things that could be positive or could be negative, and it's always worth making sure that whatever you're doing isn't putting you in a very difficult position.
I was surprised you do sound fairly. You sound fairly confident that the Bank of England is going to manage this okay, and that we may have this kind of smooth landing that you talked about next year. And that's very interesting to hear your view there as an economist.
That is my view. I think that the people in the Bank of England are the best at what they do. Generally, they are some of the top economists in the country, and you know, they'll certainly be fully aware of the trade-offs facing them. It's very hard to be supremely confident at a time like this, but I think, you know, it's more likely than not that the Bank of England will get us to a reasonably steady path. Of course, there are other things that outside of their control, which you can never kind of legislate for. But I think you know, if you look at go back and look at kind of inflation records and the sort of track record of the Bank of England since it became independent, it's pretty impressive. And so hopefully one of the biggest challenges in its independent life, but hopefully it will be able to weather it. It won't be smooth, but it will hopefully be not too dramatic. Well,
amen to that, Andrew. Aviram, when you created Lendlord, I think it's about four years ago now, we could never have imagined what a roller coaster this market, for the housing market, has been. So it's Lendlord is just such a great tool for managing portfolios in these very, very challenging conditions, and it's really been put to the test by all of these things, hasn't it? I bet when you started it, you can imagine that we would have all these different needs for this financial profiling, because some of the things that are going on now, they've never happened before.
Yes, of course. You know, we started just before COVID. We launched a product in November 2019, and then immediately, you know, like we entered into a storm. And then basically we found that digital tools like such as Lendlord can help landlords understand their current situation. back then it was mainly the rental cover ratio issues, tenants stopped paying rent, things like that. Then we developed more functionality to support that. And then we started to help investors to understand the deals that they are going to do in terms of any new acquisitions, and kept enhancing based on circumstances. And now I think that the inflation is definitely something that you need to take into account and understand how it impacts you as a landlord. And again, digital tools, technology can always be great support for that.
Yes, I agree. I think some landlords are quite reluctant to go from their analog ways into digital, but they're getting all these little nudges that are telling them you need to adopt digital tools. But all that remains is for me to say thank you so much to our special guest, Andrew Sissons, for sharing those insights, Andrew. I've learned so much, and I wish we could talk for longer, but I can see we're already running a little bit longer than we normally do. But I think it's such an important topic. I really appreciate your input, and I hope that perhaps we could have another webinar about heat pumps and sustainability in the energy sector, if you're agreeable.
Sounds great. Thank you very much.
And thank you to Aviram. For now, to everybody watching, thank you very much. I do hope you found this webinar about inflation from a landlord and property investor perspective to be insightful and to help you kind of navigate your way through it all. Thank you for watching.